understand that question, what that means, but our listening audience may not even understand
Right, we
that.
need to give the setup for it.
You got to give the setup.
Okay. Well, I'm president of a company called Pacific Private Money, based in Nevada. We are a private money real estate lender. And so we make loans to real estate investors, and those loans are funded by private individuals. We have about 200 and growing private individuals who have invested at least once with us, and a couple of dozen people that are regular investors in our real estate secured notes. So the question the caller is asking is, well, it's a question that basically says, if I invest in one of your short-term notes, and our notes tend to be short-term, 6, 12, 24, 36 months, if I invest in one of those notes and then the borrower pays me back, how fast before I might be able to get into another investment? And that actually, and I don't know if the emailer even realized when they were asking that question, that really is one of the issues with trust deed investing, is the fact that there's a lot more money coming into the market now. I have a lot more investor clients than I had a year ago at this time, and yet the loan volume demand, at least in our company, is fairly steady. You know, we're doing anywhere from 15 to 20 loan fundings per month in the Bay Area to real estate investors who are either buying, fixing, and flipping, or buying rental property.
What's the average loan?
The average loan size is about $150,000 to $200,000, paying the investor a rate between 8 and 10% on average fixed for that period. So of course that's a great rate, and we have a lot of investors who are very bullish about investing in those real estate secured notes. And when they get paid off, it's like, okay, well, how do I get into another one? And that is oftentimes a challenge for some people, because we don't, depending on the volume, you know, we may not have a loan, you know, ready for you yet. But
the key is on like this kind of question is the fact that you don't hold the money.
No, we don't. Right.
Once the borrower gets paid off, your private investor lender gets the money back.
Okay.
He can do anything he wants with the money.
Which is actually a safe thing for an investor.
Exactly.
Right.
You're not having to pay out on interest that you're not actually earning from a borrower.
Well, so to expand this even more, there are two ways to invest in real estate secured notes. One is to invest in an individual note, where you know who the borrower is, you know where the property is, and you invest your money by wiring it to the escrow company once the loan documents have been signed. It's your name on the note. The borrower owes the money to you, and your name is on the deed of trust that gets recorded. You're named as an additional insured on the policy. So you have complete control over that note. You have all the rights and remedies that Bank of America would have if they had made that note. So that is the best way, in my opinion, and it's also the most common way today of investing in real estate secured notes is to invest in an individual note. On the flip side, the other way to invest is to invest in a mortgage pool or a mortgage fund, and that is basically a limited liability company that has multiple investors where the money is pooled together, and the asset manager, who's generally a private money lender like myself, a broker, then has the power and authority to make loans with that pool of money. The difference to the investor is, if you invest in an individual note, you can basically say yes or no and pick and choose the property you're loaning against, whereas if you invest in a fund, you have no choice at all. You're dependent on the integrity
of the
manager to make prudent investments with that capital. And when you put your money in a fund, you don't get it back until you ask for it back. And when you ask for it back, if the fund's not liquid because all the money's lent out, you may have to wait a while. And so
also you don't get to pick and choose.
Right. And there's nothing wrong with a mortgage fund. It's just they've fallen out of favor in the last several years because funds were very popular in 2005 and 6 when the market turned, and there are many non-performing funds in and around the Bay Area right now. In fact, worse than that, there are some extremely large funds that went into bankruptcy, and the investors in those funds are seeing pennies on the dollar return. So in terms of our business model at Pacific Private Money, we do not have a fund presently. I look forward to the day in the future when funds come back into popularity, because I think that there are good reasons to invest in the fund. One is, of course, diversification. But at least right now, I think a number of people have have either investing in, they have their investments stuck in non-performing funds, or they've been burned by funds that have gone south, and so. So,
Mark, I've a lot of times RPM has 400 agents even in California, and a lot of times I get an email, and does anybody know a hard money lender? Would that be what you are? Is that another word for what you're doing?
Absolutely, yeah. Hard money lending and private lending are synonymous. The term private lending is kind of a newish term that we've used that's come out the last several years. And when I chose the name for our company, Pacific Private Money, I chose to go with private money as opposed to hard money, generally based on my my position that it is a different business model in post real estate crash, 2010, 2011, 2012. It's a different business than it was 10, 15, 20 years ago. Hard money used to be you were basically making a loan to someone who really couldn't afford it. It was you were lending to a distressed borrower. Well, today we generally aren't making loans to distressed borrowers, but we're making loans on what would be called distressed real estate. Yeah. Bank-owned property is considered distressed real estate. Short sales are considered distressed real estate.
But it's already distressed by the time you make the loan on it.
Right, but there's nothing wrong with the real estate. It's just, there's an opportunity there for a real estate investor to make a play. Right, exactly. And so oftentimes our borrowers are actually very, very bankable, or would be bankable if the banks were making loans to real estate investors, but they're not.
So if you had somebody that was a potential borrower rather than an investor, what would they, to try to figure out that they might be able to qualify, or how do you qualify a potential borrower?
Well, we qualify really first the asset. When someone calls us, it's several things. Number one, you should know in advance that we don't lend more than 65% of the purchase price. So if you're looking to buy bank-owned property to fix and flip, you're generally not going to find a lender willing to go higher than 65%.
You're not the FHA doing
right,
96.5%
we're not doing high percentage financing. In fact, we never really were. The private lenders and hard money lenders were not the cause of the real estate meltdown or the subprime crash, but we've kind of gotten corralled in with the rest of the lenders and with all the new regulation. But so someone would call it 65%. Interest rates, depending on where they're buying, are going to be anywhere from generally 10 to 12% to them, and then my investors who fund those loans generally get 1% less than the note rate. There's a servicing component that goes to our company for servicing the loans. So, FICO scores are not a requirement. I look more at the experience. If you're an experienced real estate investor, but you've got some foreclosures which have affected your FICO score, that is not an issue for us generally. In fact, I like experienced real estate investors, and again, we're very fast at putting together a price. Usually, if you call us up on the phone, we can just give you a verbal range within minutes of whether we think this is a deal we can fund.
Okay, really quickly before we cut to break, give out your information for people who need to invest.
Our website's pacificprivatemoney.com. Go figure, right?
Yeah.
Phone number is 415 area code 883-2150. That's 415-883-2150, or visit us at pacificprivatemoney.com.
Okay, when we come back from break, you'll ask Robert his question.
Yes.
We'll talk just a little bit about the stock market. All right, here we're cutting to the third and final trivia question. What language drives Gomez crazy when Morticia speaks it? Again, this is the Addams Family. That's our theme for today. The first three callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. Their website is lighthouse4fun.com. Call 888-912-1190. That's 888-912-1190 to answer this question. What language drives Gomez crazy when Morticia speaks it? Call 888-912-1190. Make sure to include your name, address, email address, and phone number. Speak slowly and spell it out for us. And, we got to start doing this pretty soon, too. Okay, and we will be right back. Da-da-da-da. Da-da-da. Yeah, very good.
That was good. Oh, thanks for asking those questions.
Yeah,
Those
yeah,
were good
I thought
leading
people
questions.
wanted to know.
Yeah, that's perfect, man. You're
Yeah.
a team player.
That's a
Good.
hit. We
You
like that.
might have to work on a semi-permanent slot for you here. In Southern California, 12 and 13% and 4 to 5 points is not unusual. But the Bay Area with Silicon Valley and all the wealth and all the money, and we actually don't have that many. It's not as big an industry, the private lending industry, as it is in Southern California in terms of numbers. But it's just interesting how we have. You actually can't get private money in the 8% range, in the 9% range. We do those loans
Yes.
quite often. So
When clients come to me and they're looking to borrow, and I tell them, I said, well, here's an example. The kids inherit the house from the parents. It's worth $500,000.
Right.
They want $100,000. The house is free and clear.
Yep.
They all are great. They all make a bunch of money, and they are not going to pay less than 8 or 9%, less than 3 or 5 points. Do you think your situation is better than that?
yeah.
So it just doesn't, and
Yeah.
it's a function of how much money is sitting idle, and if
Yeah.
somebody says, well, I'll do it at 6%, which I don't
You know, at the end of the day, I just want to do loans.
How did you keep tabs of what the other private money lenders are doing so you know you're in the market?
I get all their email blasts.
Yeah.
They're telling me, and some of those guys are advertising, 2 points and 7.99. There's a, Sequoia here in Santa Fe advertises that. Now that's their super prime. It's got.
I wonder if anybody's ever got
Right,
that.
I don't think so. No, and Jason, I don't know that anybody's
Yeah, I
actually
wonder if
got
that's
Plus-
if
plus
the Attorney
50
General would like to
Plus
hear something.
$5,500 in fees.
Yeah, well, that's just it. Yeah, the junk fees are probably higher than mine, but anyway, it's under Section 32 or 35, and it's their primary residence. You have to verify ability to repay,
Yeah.
which
Not
is a
without the
gray
sale
area,
of-
right?
without the sale of the
It
property.
is just
Nobody's as a private residence. They're doing it as a business to rent out. Then afterwards they
course.
decided to move in.
That's right.
well, that's okay because see, when in my set of loan documents, if you say this is not intended to be my primary residence, therefore.
Third trivia question, and then
Yeah, I want to get into
you wanna
like
get
just
into
talking
your
about,
favorite, yeah.
let's talk about where you see rates and the housing market
Yeah.
going. I can share a little bit about, I went to Bay Area Wealth Builders last night and saw Robert Campbell, who's, an economist who makes his annual predictions 7 years in a row now at the local Bay Area Wealth Builders meeting about where.
I'm just going to make a quick comment about the
Where the
stock
economy's
market on
going.
that. And go
Yeah,
into
sure.
it.
Yeah,
Sure.
it'd be
Okay.
interesting to hear.
Excuse me. Okay, you guys ready?
Yep.
Okay. And away we go. Welcome back to the Best of Investing. I'm Edward Brown, your host, along with my co-host Mark Hoff of Pacific Private Money. When we cut to the last commercial break, we asked this trivia question. And again, the theme was the Addams Family. What language drives Gomez crazy when Morticia speaks it? Anyone?
Morticia, you spoke French.
Ah, that's right. Oh, Tish, you drive me crazy when you speak French. That's right. Very good. Okay. Quick note here about the stock market. It's been going up a bit, but without the volume. So we're wondering if the average retail investor has stayed away because of confidence lacking in the economy, which kind of leads into what you were going to ask.
Well, lack of confidence, I think, is one of the primary causes, I think, of both stock market melees and real estate market melees. I mean, those of us in the business know that the fourth quarter of 2011 was very disappointing for the real estate market. There wasn't the unit sales that people were hoping for and or expecting, and we saw prices continue to drop. And a lot of us think it has to do with, a couple of things. One, consumer confidence being at an all-time low, and number two, the fact that the media continued to play up reports of predictions of continued declines in real estate prices. So that's the problem with deflation. If you think something's going to be cheaper in 6 months, you're not going to buy it today unless you have to. And for a lot of people who are out there renting and shopping for homes, if you don't have to buy, because maybe I can get that same house for, who knows, $20,000 less, and in the spring, I'm going to wait. So
we'll get you went to a very interesting seminar.
I did. I went to the Bay Area Wealth Builders meeting Thursday night, and Robert Campbell, who is a San Diego economist, came and spoke. He spoke 7 years in a row at the Wealth Builders meeting, and he comes and for about the last 20 years, he's been studying real estate trends, and so a lot of people follow his newsletter and his predictions for the coming year, and it was very, very interesting to hear him. And of course, it's still January, so this is the month for predictions. What's going to happen in the economy and in the marketplace and in real estate in 2012? So he had an interesting take on interest rates. But before I share with what he said, Robert, I'm a little bit curious what's your crystal ball say in terms of where rates are heading this year and where the real estate market might be heading this year?
Well, I'm not sure what the eminent Robert Campbell said, but I'll stick my neck out from my limited experience, and I agree with you that it's hard for someone to get enthused about investing in either a house or a stock market when predictions are basically that we're not coming out of it, and although it may be a good time to buy, it may be a better time in the future, it doesn't make people that enthused about putting their money into the market. That's why individually and corporate there's so much money on the side, both in the market, stock market and the real estate market. From what I see, and I believe that we're not even at the point that we're on our way up out of this. When we started this, George Soros, who is a billionaire, he said there's a 6-month cure to this situation or a 10-year cure. And the 6-month cure, at least in the real estate, was to do a program that maybe eventually we do and force all the banks or ask all the banks to give the people an interest rate that lets them stay in the market and bifurcate their loans so that if they were upside down, the bank would cut the loan in half and just have them pay on 90% of the current value. The residual would go in a toxic box. It wouldn't accrue interest. They wouldn't have to pay. And if they ever sold the property, they would split the proceeds with the bank. And if the
like
banks,
a JV partner.
Even if the banks did that today, they would